All right, everyone, welcome to podcast number 3 of Stress-Free Retirement. Today, we're talking about a couple key items. One, it's going to be what's going on in the world today, especially with US Treasuries. There's a big impact on the economy and where stocks are going. A lot of recession signs happening. We're going to go over that today. The second thing we're going to go over, and more financial planning, we're going to cover some real estate, how you can use real estate to retire, different ways I've seen clients do it, ways you can do it too. And we're also going to cover a new thing kind of on the market, not too new, but something called a RILA. You might have seen these being offered by some companies. We'll go over how they work, where they fit into a strategy and what that looks like today. So first thing, talking about the yields. Now, for those who have been following the 10-year yield, currently we're at 4.33. That's a pretty high mark. This is kind of actually a year-to-date high. Back in October last year, the 10-year yield got close to this, and then it's kind of gone down. Now it's back up. Now it's gone up since May. We were at 3.4, almost a full percent in the last 3 or 4 months. Here's what's happening and why it's going up so much. One, the Fed has raised rates, not that much. And the other factor is other countries are selling US Treasuries. Happen to be the two biggest countries that own US Treasuries, Japan being number 1, China being number 2. They have been liquidating out of US Treasuries, which is now causing the yield to get bumped up. Right? People are selling them off, yields are bumping up higher, bond prices are going down while yields are going up. So I've been holding on to a 10-year yield. If you looked at it, if you bought it 2 years ago, looked at it today, you've lost money inside of there. If you chose to sell it, you'd be selling it at a discount. Why is this important? Well, one, you have foreign investors in the U.S. economy pulling out. Why are they pulling out? The big thing here is that the yen, right, they're trying to prop the yen back up. Also, Japan finally has positive interest rates. For the longest time, Japan has been in a negative interest rate territory, close to zero. I mean, it was nothing. So if you put money into a savings account over there or any kind of Japan treasury per se, you are not earning a lot of money on that at all. U.S. was a better place to be. They trusted the U.S. government. China, the kind of the same way. They put money over here. Now, Japan, they're kind of putting money back into theirs. Their government treasuries getting a little bit better interest rate than they were previously. China, on the other hand, different scenario. China's actually facing some very volatile markets on their end, a lot of credit problems. So right now, if you looked, some major real estate companies are going under or ready to file for bankruptcy over in China. What happened was they built all these buildings. People got these buildings, paid a mortgage for it. They weren't completed. People stopped paying the mortgages for these uncompleted buildings, and now there's entire ghost cities. Yeah, ghost cities. There's skyscrapers that have no one living in them in China all throughout. And then China's population's kind of been on the decline. They thought it was going to rise. That's why all these developments were happening. And now we're seeing this kind of major drop-off in the Chinese population, Chinese birth rates, and there's not really anyone to buy these apartments. And now these companies that are holding them, the banks that are holding these notes, are now going under. It's not a minor thing. This is a hundreds of billions of dollars kind of deal going on here that could really affect China's economy. And because of that, I think they are kind of preparing for a credit crisis on their end. When that happens, a credit crisis is no joke. When that happens, essentially, people will start bankrupting left and right, and someone has to hold the bag eventually. At this point, it looks like it's going to be the Chinese government that's going to have to hold the bag. I mean, these companies are going to wonder. They probably don't have the assets to pay off this stuff, and it's just going to end up hurting the economy as a whole. We'll see how it all plays out on that end, but that's a big thing there. On the other hand, with Japan, a little bit different story, which is now causing our yields to rise. Now, it's a good thing yields are rising. Now, with that, combining with yields rising and bond prices going down, rates might be rising again too. This is why they shot up again recently. The Fed might raise rates again the next time they meet. If that does happen, we're going to see a market get pretty volatile, People do not expect rates to go up anymore from where they are today. Looks like they just might. We'll have to kind of wait and see on what happens there. But that's some big news going on right there, and we'll see how this plays out. The 10-year, I think, is a really big focal point for the rest of the year, determining on where the market goes from here. If rates stay lower, we're good. If rates start going up, creeping higher, that's not so good. Right? And what does this also affect? Kind of good segue into the real estate market. So the real estate market right now is hurting in a lot of areas because rates are so high. People are struggling to afford their mortgage. When that happens, and you combine higher costs of expenses, wages have not gone up, so we have more expenses for the normal family American household. Their income is not increased, and now debt is getting more expensive. They want to buy a home, it costs a lot more. If they want to go to the grocery store, it costs a lot more. Gas costs more. Everything costs more currently today, but their income has not gone up. That causes major issues. Combine that with some of these people being in their 30s and 40s with kids who have student loan debt. They haven't paid that student loan debt the last 2 years, and now that's getting started back again here in September, October time period. We're looking at maybe at a credit crisis ourselves here in the States, where we have a lot of credit going on that might start getting unpaid. I saw the other day the US savings was at an all-time high going into COVID. Since then, people have basically been living off their savings the last 2 years, and that has gotten depleted. We're now at one of our lower points in the last 20 years in terms of savings. So why I mentioned this, I mentioned the housing market. People can't afford these homes, but home prices keep going up. And I mentioned I was talking about real estate and how to retire, but I guess the first thing the answer is, will real estate go down or up? Depends on your area. Real estate is super city, regional affected. You maybe live in one town and one town over, real estate drops a lot, the other town doesn't. Could be because of the schooling that's going on, could be location-wise, it's a highly desirable area. So you're gonna see a lot of these C and B class neighborhoods, which is kind of your lower tier neighborhoods compared to the A class. They're going to struggle most likely. They're not as wanted. So as people can't afford these things, they're going to do something. Normally it's people who have the money to do it, and they want to live in nice areas. So I think the A-class areas will perform better, getting to kind of the more investment side of stuff. But in terms of how you can use real estate to actually go ahead and retire, here's a misconception about real estate. It's all about cash flow. And it is, but it isn't. Here's the reason why. Cash flow, if you want to invest for cash flow, you invest in the middle of Indiana, Midwest kind of area, and you can make cash flow. Problem is that property that you bought for $200,000 probably will not increase in value in the next 10 or 20 years. You'll make a 8% cash on cash return, but that's about it. So in order to get, if you want $100,000 a year, for instance, in cash flow, you would have to put in equity-wise, around $1.2, $1.4 million, manage those properties, manage turnover, costs, and all that. And if you get an 8% return on your investment, on your initial investment, you're looking at $100,000 that you would receive there. Easier said than done on that. Normally your costs eat into that return more than people think. But the appreciation is really where you make your money. And that's where retirement-wise, if you want to retire off real estate, it's not necessarily the cash flow you're making from the real estate. It's more from the equity you make from your real estate. And quick explanation, if you buy a house in Miami 5 years ago, the house might have been $250,000, depending on the area. Currently, these houses are going for double they were 5 years later. Some places 3 or 4 times more. So maybe you weren't making cash flow on that property. Maybe you were breaking even on the property. You bought it for $250, now it's worth $600. Well, you made $350,000. That's a lot better than an 8% cash on cash return, some of which gets eaten away and you have to put towards CapEx and all that stuff there. So the whole dream of owning a bunch of properties and renting them out and retiring, realistic for some, but you have to build up to that, and you use equity to build up to that. Most people with big rental portfolios, what they did is they used the equity they got from their current homes that they own, right? They do a cash out refinance, or they sell the home to get a bigger one. They buy a multifamily, they buy a 10 unit, a 20 unit, a 30 unit. They build up and stack them together. But the whole point of this is the cash flow enough to keep the property, but either do work on the property, force equity into the property, or just buy in areas that rise in value quicker than others. Typically, these are more coastal cities. Think, in Florida, like Miami, Tampa, Orlando area. Then you got the Carolinas, you got like Charleston area, you got DC, New York City, California, a bunch of places over there, Texas. There are certain areas that are very highly appreciative. Typically, it's where the population is going. If you invest in areas like that, you get the appreciation of those assets, use that appreciation and get you more cash flow. So it's very hard to save your way to cash flow in real estate, to sum it up. It's hard to save $1.6 million, put all that into real estate and make an 8% yield and get $100,000 a year coming out of there. It's hard to do unless you make a lot of money, of course, every year. What you have to think more, if you're just getting started in the real estate field, is how do you build equity? And a lot of that takes more work, takes sweat equity, actually repairing homes, fixing them, and then getting that equity up, refinancing out of that equity, and now buying other homes that can produce cash flow. If you're gonna get into real estate, it's more of an equity game than a cash flow game. People forget that or don't realize that getting into it. They just buy for cash flow, don't think about how they can appreciate the asset they're buying, and that becomes a mistake. And that goes for almost anything, businesses, all that stuff. Cash flow is great, but at the end of the day, it's how can you appreciate that asset? Typically, it's by increasing the cash flow through different ways and adding improvements to that property to make it more valuable. And that's, I think, a misconception about real estate. I want to cover today really quickly because some clients of mine, they want to go buy real estate. It's great. And you got to remember, it's not about the cash flow entirely. You got to make enough to pay for the property and put a couple of bucks in your pocket to help pay for the expenses down the road. New roof, plumbing, things go wrong. New oven, all right, $400. New fridge for a tenant. That's what you got to pay for. If you don't make money on the property, it's tough to keep it. If you can keep it, though, long enough to have it appreciate, that's where you really start making some progress down the line. All right, so that's the real estate spiel. Want to mention that. Is it a great time to buy now? Who knows? Rates are high. If rates do drop again, we're probably going to see home prices increase again at that point. I've seen some news around making interest rates lower for first-time home buyers. If that happens, again, might increase prices. So I don't see prices plummeting 40% in certain areas. Some maybe. The office space, commercial real estate is taking a big hit. Residential, though, tough to say. Not enough supply for it to cause a downturn. That could change if people start getting foreclosed on. Don't see that happening yet. If it does, I'll make an update to that. Now, other thing I want to cover today was something called a RILA. So for those who don't know what a RILA is, it's a registered index-linked annuity. What that means, essentially, it's an annuity. It's a link to an index that you get returns on. It's a form of a variable annuity that's out there today. And you can lose in it, so it's not completely protected, but there are protective measures you can take on that annuity. So a lot of questions about that from current clients today. Thought I'd put a little segment on here today in the podcast about what these things are and how they work. Essentially, to give a very broad example of this, you can put your money into one of these, so you put $100,000 in, and it follows the S&P 500. Now, the first thing you got to choose is what index you want to follow. S&P 500, let's say, is your choice. Great. Then after that, you have to choose whether you want to have a cap, a participation rate, different stuff that you can choose on the investing side. Now, if you do a cap or a par rate, what that means, a cap is there's a limit on how much you can earn, right? So let's say it's a 1-year term, and you only can earn 20% in 1 year. Okay, that's a cap. A par rate is you get a participation rate. It could be 110% or 90% of what the S&P 500 does. So if it does 10 and you have 110%, you get 11. If it's 90, you would get 9. So how that works, you pick that index, you pick what kind of returns you're looking to get, whether it's a cap, a par rate, sometimes they're a mixture of the two, and then you choose the length of time. Now, I've seen some that are 1 year, 3 year, and 6 year terms. All right, those are broken up. Typically, the longer term, the higher par rate or cap rate they're going to give you. Kind of like getting a longer term CD normally equals a higher interest rate if you do something like that. So that's how essentially they work in a sense. Of course, you get in more detail there, but you can choose an index, you follow it, and you get this par rate or cap rate. Now, most of these offer something called a buffer. What a buffer means is, let's say a buffer is 10%. If that S&P 500 index you're following goes down on that 1 year term that you have, it loses 20%. And the buffer is 10% in this scenario. If you lost 20, the buffer's 10, you subtract 10 from that loss, and you're only going to lose 10% in your account that year instead of 20. So a buffer minimizes your losses in a portfolio. So it has some protection on the downside there, where you're not going to lose as much as everybody else in the S&P 500 if you have that buffer. You have a 10% buffer, a 20% buffer, different options out there depending on the company and product you're using. But that's how that works there. So you're protected on the downside, and you also get the upside of the S&P 500. Now, some of these par rates have actually gotten relatively high, over 100%, which might not last, but right now they are, and a lot of people are considering these investments to add to their portfolio. Definitely to look at your current situation. A lot of these have surrender charges on them, so if you need the money in the next couple of years, it might not be the best choice, but if it's in your IRA and you might not use it for a while, something to take a look at and kind of see, does it fit your needs? I would talk to your advisor further on that, but it could give you maybe a better return in the S&P 500 potentially if you get a bigger par rate per se on that. Also some downside protection. So take it as you want it. Thought I described those to you. I think those are kind of more popular right now today. So figure a little inside knowledge on how RILAs work. Typically variable annuity companies will offer these. The fees on them vary. So sometimes they require a fee of 1%, 1.5%. Some are less, some are more. Depends on the company. So you do pay a fee for that buffer and for that par rate you're getting. Again, it varies per company and depends what you're looking at exactly. So that's a RILA. Little info on that today for you. And that wraps up our episode for podcast number 3. Hope you enjoyed it. Next week, we go over some other stuff, including some, hey, the 60-40 portfolio, is it working? Going over some other news that we're going to get this week, as well as, hey, with Roth conversions, a previous episode on that, what are some other ways you can do it? So keep an eye out for those episodes, and looking forward to talking to you next time.